my last video, I talked about the 4 qualities I like to see in a company that I look to add to my stock portfolio. In this video, I want to talk about the 4 qualities I like to see in a stock that I'm going to add to the stock portfolio. The stock represents ownership in the company, and while the company's qualities are very important, the price you're paying for those qualities also matters. If not, you risk the chance of overpaying even for the best companies, which may lead you to underperforming or to having to wait a long time to get your money back. So in this video, I want to talk about what I want to see in the stock before I make a decision. The first thing I'm looking for, absolute valuation. I want it to be attractive. What do I mean by this? We have all these terms, price, value, and now I'm throwing out valuation. Value is what I think the company should be worth. That's an opinion, as I've said before, but it's my reasonable argument for what I think the company should be worth. The price is how much the shares are now. An attractive valuation is when the price is meaningfully less than the value. That's what I'm looking for. An opportunity where I can argue that the value should be here and the price I'm paying is down here. How much? There's no perfect number here. I like to see 50% upside. That's just a rule of thumb. It's not anything magical. I like to see some real opportunity for 50% upside in the next couple of years. That's where I think, A, there's some real opportunity to do well. And also, as I'll talk about in a little bit, if I'm wrong, I don't hurt myself too much. We'll spend a lot of time on how you decide what the value is, how you make that reasonable argument. I'm going to do a whole course on how to value stocks. For now, where we're just talking about what we want to see when we're buying, you want a real difference between the price and the value, which is the attractive absolute valuation. An attractive valuation needs to be more than just an absolute basis. You also need to understand it on a relative basis. This gives you context, so you're not just picking a number and hoping it'll come true. You're actually going to be able to see that either this has happened in the past, or it makes sense compared to other companies or to the stock market as a whole. Otherwise, the market might never actually agree with you. You can say that a company is worth 30 times earnings and make an argument, but if the company is only traded for 20 times earnings in its entire career, you're probably not going to see a 30 times earnings number without some major change in the company or in the market. The 3 ways we do this, we've talked about in another video, but there are 3 ways we can get relative valuation. One is to compare the company to its peers, to look at how much the company is worth right now, its pricing is compared to the value you think it should be, and then you compare that to the other companies in the sector on the multiple of earnings or on other valuation metrics. I used to do this all the time. I used to just pick the cheapest company in the list and assume that they'll just catch up to the crowd. It doesn't work like that. That's not how you should use this, but you should be able to put this into context. You should be able to say, okay, if company X, I just invested in Levi, for example, Levi Strauss. If they are trading at only 10 to 12 times earnings, that sounds cheap in comparison to the market, which I'll get to next. But if I look at all these other apparel companies, they're also trading quite cheaply. So maybe there's something else going on that I need to figure out. That's what this can help you with. I mentioned the market valuation. That's the next thing. You can compare how the stock trades to the overall market. In theory, the market should represent an average baseline. The S&P 500 is, as always, our stand-in for the market, and it trades at somewhere between 20 and 25 times earnings based on whether you're looking at forward earnings or past earnings and which data source you look at. If we take that as sort of the average multiple, a company that's trading for less than that is being viewed by the market as either likely to see earnings decline or a poor quality company. And a company with a higher multiple is seen as a high quality company or a fast growing company. Whichever one it is, you need to be able to put your company into this context and understand, is it reasonable to expect company X is going to get from 10 times earnings to 25 times earnings? Is it reasonable to expect that company Y will maintain its 30 times earnings? Is there a reason that company Z trades for less than 15 times earnings? All of these things are useful for you within the context of the market. The last thing we can do contextually is look at past trading, historical multiples, which, as we've talked about before, are very helpful to understand how has the market viewed this company over time. I have a company which trades at just over 6 times earnings, which is really cheap. And it is cheap compared to what it has historically done, where it has usually been around 9 to 10 times earnings. In theory, I could argue, well, it'll just return to 9, 10 times earnings and story over. It'll be a winning, that's your 50% upside. In reality, there's a reason that it's trading at 6 times earnings, so you have to understand that. And also, it will be hard for me to argue that once the problem is resolved, the company should trade to 15 times earnings. Historically, the market has put only 10 times earnings as the price, as the ratio that it wants to pay for shares. It's going to be hard to see that changing in the near to medium term. That's where historical multiples can be really valuable. Once you have that valuation, you need to understand why it exists. I don't believe in efficient market hypothesis, which argues that all prices are basically correct based on all available information. We see mistakes in the market all the time. There are real opportunities out there. But there's no free lunch either. If a stock is trading for 6 times earnings when it normally trades for 9 to 10 times earnings, there's a reason for that. It could be wrong. You can argue around it. You can say, if I wait it out, I will be proven right. But you need to investigate that. The same in the case of Levi, Strauss, and all the other apparel makers. They all trade cheaply. There's probably a reason for that. And I need to understand that before I make my investment. That's what I need to do. I need to be able to put my head around it and start to argue why I think this matters, doesn't matter, or what could change in the coming months, years, whatever my time frame is. I usually try to invest with a time horizon of 2 to 3 years, because I think anything more than that is hard to predict. Anything shorter than that is too random. If I'm looking at that time horizon, I try to understand why is there that valuation opportunity in between what I'm looking for and what the market's looking for. That's a really important point, and it's one that I think many people forget to think about. They just take the numbers as is or the quality as is and forget that there's also what is the market thinking and why is the market wrong. The last thing I look for is an attractive risk reward. I've talked a lot about the reward so far, about what I think the stock should be worth, why it's right now less than what it's worth, why I think there's at least 50% upside, all those sorts of things. But I also want to make sure that I don't get myself into trouble. Famous investor and investment book writer Joel Greenblatt said, look down, not up. If you don't lose money, every other result is pretty good. Warren Buffett's rule number 1 is don't lose money. You're going to lose money. It's not that, but you should understand how could this go wrong and how badly could it go wrong. I like to see at least, again, rule of thumb, 2 times upside for every $1 of downside. So a 2 to 1 risk reward. If I take Steelcase as a company I invested in, I did make an argument when I bought the shares at somewhere around $7.50 that it was worth more than 50% more than that. Somewhere in the mid-teens is where I think it could be at least worth. But I had to look at what if I'm wrong. It's an office furniture company. That's a tough industry. Who knows if we're all going to go back to the office? It's a smaller industry than it was before the pandemic, and so on. So when I look at Steelcase, I have to look, first of all, is there a chance of bankruptcy? I have to assess that. Well, it makes positive free cash flow. Its balance sheet isn't that bad. I think it's actually pretty decent. I don't think bankruptcy's on the table. Great. That's the most important. You can take that off the table. That's how you lose all your money. But then you have to look at, what if I'm wrong? What if it doesn't really grow from its current low pandemic levels? I did the math and I decided, well, in a worst case scenario, it's probably worth about $3.60 a share, which is 50% downside. That's pretty significant. But then my argument on the upside is if it gets back to the earnings level that I think it can, which will be its pre-pandemic level, and you apply a reasonable multiple, it's probably worth about $17 a share. That's more than double where it is now. There's my 2 to 1 risk reward. That's what I'm looking for as a sort of, again, rule of thumb, but it's more the example. You have to look down. You have to understand where you can make mistakes. You have to get comfortable with where you might be wrong. And that's where you can then buy if the stock goes lower and you feel okay, or where you know to cut your losses because you made a mistake. You will never not lose money, but it's always worth remembering that you can lose money and to think about this and how you need to control your analysis so that you get it as right as you can. Underlying all of these is the concept margin of safety. It's one of the most famous concepts associated with Benjamin Graham, the father of modern value investing, Warren Buffett's mentor. There are two concepts that are really famous associated with him: margin of safety and Mr. Market. I've already talked about Mr. Market a little bit. Margin of safety, the idea is more or less what it sounds. Graham writes more or less that margin of safety is the difference between the price you're paying for the shares and what you think the intrinsic value of the company is, how much you think those shares should be worth, as estimated by the analyst. It's a helpful concept. That's where the idea of having at least 50% upside comes. That's where understanding the risk reward comes from. All these things are ways to make sure that I have a reasonable margin of safety. At the same time, you have to be careful about it because there's no magic bullet. Let's go back to that definition I paraphrased. Difference between the current price and the intrinsic value as estimated by the analyst. Estimated by the analyst. That's the whole problem here. All of this is based on the work we do. I threw out some numbers at you about Steelcase. If I did bad work, bad analysis on the stock, if I misunderstood what matters, if I misunderstood where the stock is going to go or where the revenue is going to go or the earnings or anything like that, or if bad luck happens, anything could cause my shares to plummet and me to be wrong. And if things work out well, it still doesn't mean that my analysis was right. I may have gotten lucky. That's where I think margin of safety is most helpful, is not in terms of being some foolproof approach to investing, but building in buffers and ways for you to acknowledge where you might be wrong. I remember living in a house for a month in New Orleans where there was a stone in front of the house that said, "You may be right." And I always liked that because it implied the opposite. You may be wrong. You may be wrong about anything in life, but in investing, about all of your analysis, you need to keep learning, growing, building on your analysis, better understanding companies, better understanding industries, better understanding how stocks work, how they move, and so on, developing your instincts. And if you can build in buffers, make sure that you're not in very dangerous downside situations, make sure that you have attractive upside when you get it right, then you're giving yourself your best chance for success. I've talked about 4 things that I look for in a stock: an attractive valuation, attractive relative valuation, a reason for the disconnect that I understand why there's a difference between the price and the value, and a risk reward that I find favorable to me as the investor. I want to see as many of those boxes checked off, while also seeing as many of the quality boxes I mentioned about the company last time checked off. You're rarely going to get all 8 boxes checked off. The best companies don't go on huge sales. The companies that are on sale are often not the most high quality. And as you learn and as you find your style of investing, you're going to see which side of the spectrum you want to lean more towards. Some prefer to lean towards the quality. Some feel more comfortable with the price. I feel like I've become somewhere in between those poles. Whatever it is, the more you can kind of understand what you're looking for and what turns into good investments for you that you can hold through the down times so that when they go up, you really benefit from them, those are the investments that you want to find. And you don't need that many. In a portfolio of 6 stocks where you get 3 meh, kind of in line with the market, 2 wrong, but not catastrophically so, and 1 really right, your portfolio is probably going to do fine. Warren Buffett likes to talk about only swinging at fat pitches. That's what we're doing. In these videos, I've talked about what we want to see in a fat pitch, how to recognize the fat pitch, but then you just got to wait and sit back until you take your swing. In my next video, I'll talk about the mechanics of taking the swing, how you buy shares, the emotions you'll go through, the nuances of the orders you might make, and so on. Subscribe to the Short Investing Guide to get more of this. Find my website, shortinvestingguide.com. Leave a comment, get in touch. I would love to hear from you. Thanks so much for watching. See you next time.